Hey everybody, this is Paul making a quick video. Just an impromptu video, not at the end of the month or anything like that. Just kind of an update on what I think is going on in the market right now. Um, Different risks that are occurring in the market, and how I feel about how the rest of the year is going to play out because there's some pretty dramatic things going on in the market right now. Um, Previously in my last video, I went over how just from December 1st until when I put out the video on December 23rd, the market ran just a dramatic amount. And it wasn't a Santa rally, it was okay, the Federal Reserve is all of a sudden serious about this inflation thing, and they're gonna either press the brake pedal really hard or they're gonna do they're gonna throw everything they can at inflation, or at least they're gonna say they're gonna throw everything at inflation. They might not actually end up doing anything. That's still to be seen, because they're saying some things but actually still doing something else. The most obvious example is so what got the market completely freaked out right now is when the minutes came out from their December meeting. They said, okay, well, we're going to do a rate rise. We're going to stop buying bonds, but we're also going to start rolling off our balance sheet. And what that means is the way that this has been working right now, and the reason we don't have MMT, which is modern monetary theory, which is, just make infinite amount of money, is whenever the Fed buys a bond, they come, the bond has a certain date on it, says this is the maturity date. Instead of just paying that bond, the U.S. government basically says, well, hey, here's another bond. you know, Here's an IOU. So that's why the rates have kind of stayed low, right? Because the Fed's like, yeah, sure, we'll buy this bond. We'll take this IOU with a 0.25% return. No actual person who buys bonds would be like, yeah, you know what, that sounds really good. That's a really good rate. I mean, unless you're like a Japanese pension fund or like an, European pension fund dealing with negative rates. But they don't need that many. They need a few because they're required to, but. So the Fed's saying that, and literally anybody you ask is going to say that is how you can really get rates up really quick. Saying that you're going to roll off the balance sheet, which is $9 trillion, which is the big, massive elephant in the room. That's how you get interest rates to go. So what's going on right now is tech is getting hammered, just flat out hammered. There's no other way to put this. You can just kind of look at the Nasdaq. I mean, this straight line down is kind of an indicator of how it feels right now to own tech stocks. If you look at kind of what's down today, you got a few Chinese stocks up, but that's because they're literally propped up by the government. But I mean, tech is going to get hammered. Anything that's not, I mean, if you're not hitting your earnings as it is, you're already getting hammered in the market. But if you're a tech stock, you're not hitting. There are no earnings really on a lot of them. It's just basically like, someday we'll be profitable. That's the kind of the Cathie Wood view of the world. It's like someday they'll be profitable, maybe 5 or 10 years from now. But the problem is they have to stay open with debt. Well, debt goes up very quick. And when the Fed starts pressing that gas or brake pedal just a little bit, those are the stocks that get hit the hardest. So, yeah, there's a few things going on right now. So basically what's going on is since I made my last video, dividend stocks have ripped higher, just ripped. Um, I did some simple math on this. Basically, so for example, in my last video, I think I was 60,191, I believe the amount was what I had invested. And then right now I'm at 61,920, which is close to a $1,700, $1,800 difference in 2 weeks basically. Yeah, 2 weeks. I made the video on the third, so this week and then this week. So $2,000 difference, or $1,700, sorry, and then you include this. So why? Like, why is my type of portfolio going up so fast? Like, what in the world is going up? Because if you look at just just the absolutely dramatic increase in my portfolio value, is basically I was at 67,000. Now I'm at, so if you just put these two numbers on top of each other, this is why I like keeping a spreadsheet that I have a tab that basically where I document a historical view. So if you go right here back to December 1st, I'm at 73,000. So that is a difference of, and this is just to demonstrate the dramatic increase in a dividend focused portfolio. This only happens very rarely. Normally, it really, really pays off to be in like a tech sector type thing. Because what's normally been going on, at least in my lifetime, is the Fed has always been reducing rates, reduce rates, reduce rates, reduce rates. And then the safe stuff, like the Cokes of the world, the Pepsis of the world, yeah, we can keep some money in those, but the real money is in like Apple, Microsoft, Google, that kind of stuff. Those things that are always going to go up because they have such low rates, or the Teslas of the world, or these biotech companies, or these like futuristic companies. So the reason why my portfolio is ripped so hard, like just going up so fast, is because it's in mostly what's called a value play. So what that is basically consumer focused stocks in an economy where the consumer is still healthy, they're still buying products, and stocks that with with companies that have incomes that have like 50 years worth of income kind of stuff, utilities, that type of thing. So these stocks have just ripped dramatically higher in less than a month. And the reason why is very simple. They have a dividend that's paying more than what the U.S. Treasury is paying, and they have stable incomes. So something like AbbVie has just gone through the roof since I bought them. Just pretty much anything like Walmart, for example, Walgreens, Verizon is actually going up dramatically, which is crazy because Verizon has been down for almost a year for me. AT&T is just a ridiculous. It was like AT&T went all the way down to 22, almost $21. It looked like it was going to go out of business at the rate that they were going. Um, like they were at 23 right here when I jumped back into them, but I mean, they were just going down, down, down. And now all of a sudden they're just going up because they're starting to do these little spin-offs. Procter and Gamble, for example, 10%. Pepsi, 20%. Just anything that is consumer focused, dividend paying, and has very, very, very stable income for. And these are the types of stocks you would normally see start to rally when you think you're going into a recession. So that's kind of like another thing. And then also you got the banking sector. So the reason why I don't think we're going into a recession right now is because the banking sector is still very healthy. So what that means is home loans, car loans are still going on. So the places where consumers get loans from are still very healthy. So consumers still have access to credit. So you're going to still get 50 credit card offers in the mail a day. So what happens is basically if you look at it, the one concern I had was the a lot of, especially in December, is a lot of pension funds and whatnot were all piling into the long end of the treasury, which is like the 10 year. So I guess this would be the middle part, but they were piling into the 10 year. So this was going down dramatically, and the 2 year was starting to go up as the Federal Reserve was talking about hiking. So it looked like these two were going to invert for a second. Once those two invert, that's kind of your red flag that loan demand's going to start to fall. Banks are going to start to cut back, get a little more strict. You'll start to see the housing market go, and with that goes the rest of the consumer base. So right now, what's going on is just you can see right here. So the 2 years staying steady right about here. So they're pricing in another rate hike. So that's another thing that's going on. Is like the bond market's pricing in another rate hike starting in March. So we went from we might taper, we might do something, to now we will taper, raise rates, and we might start rolling off the balance sheet way, way, way sooner than you thought. So, as it stands in the market, what's going on right now? Well, the problem is next week we have an inflation report that's going to come out sometime this week, and it's probably going to show 7%. First of all, that's very bad for the Democrats. Second of all, that's very bad for any more stimulus coming out of Washington, because 7% is going to scare a lot of people. You're going to see some very negative polls come out. So it doesn't matter how many jobs were created today. It doesn't matter if what Biden does right about now. Inflation is the big monster in the room, and you can see it with oil almost at $80 a barrel. You can see it with natural gas, especially. Just these frackers and whatnot have not come back online as they expected. They will, because they have to pay down their debt. I mean, because you have to remember, as borrowing cost goes up, these guys still have to pay back their debt. So you're going to see something's going to slow down. So what's going to happen is basically, come next week, the market's going to be very nasty. I expect, especially if you take the last time that we had the inflation number that came in at close to 6%, the market, like, that was the big news. Like, that was a very, very big thing. So right now, I'm going into 2022. It's going to be a very choppy year. As it stands right now, the consumer is still strong. So, like, GDP numbers will continue to prove that this type of portfolio is good to be in. Anything that comes out from the Fed that says they might go slower will be good for tech stocks. Um, but things like if you own Bitcoin, that kind of stuff, you're just going to keep getting hammered. Unless something dramatically changes. Because right now, just the massive rise, the way that these are going up so quick, is just causing problems. So that we'll have to see how it goes, but it's all going to come down to the Fed. And the Fed has an enormous amount of power over this economy. Just an enormous amount of power over this economy because they're enabling just these low rates. So the portfolio is doing really good right now. I expect it to do really good, but the problem is the higher stocks go, the way that people are just piling out of tech into what's called safety, which is this kind of portfolio, is you get higher stock prices, but you also get lower yields from your dividends. So when my dividends pay out, they're going to pay out buying a higher stock price with a lower yield, which sucks. It's not fun. So my portfolio is still balanced. This QYLD number updated, and I don't think they're going to keep paying out at this rate. All right, it says like 49 cents a share, which is like a 20% payout. I think that's a one-time payout. I think next month they'll go back to the 23 cents a share that they're always famous for. So this current this current dividend number here, this 3,145, I don't think that's accurate. I think it's more closer to like 2,600, 2,700 where that should be. But that's where it's currently at. One big stock that I did drop for a large profit was Ford. I bought it at 19. So I bought Ford. I think it was 70 shares or something like that, or 50 shares. Maybe it was 60 shares, but I bought 60 shares at $19. And then, where was it at? It was somewhere in here. Yeah, I bought it somewhere in here probably. And then they came out with that electric truck news, and then they shot up to here. Um, so somewhere in there. It could maybe run higher. I'm not even sure what it would run to. I just don't know enough about it. All I know is that I made a dramatic amount of money, and their dividend, by my math, would have taken me 10 years to pay me the amount of profits that I made on just taking the capital gains, which means I bought low, sold high. So it would have taken 10 years for the dividend to pay me as much as I made just selling the stock that I had. So, yeah. So I took that. reinvested a large amount of it into mostly financial type things. So like I put money into Regions, for example, the local community bank, Maine, which is a lender. I put some into Energy, which is the electricity provider for the Southeast. AbbVie, I bought one share. I invested a large amount of money. I bought a lot of Walgreens because they beat their profits yesterday. Even though the stock went down 2%. So the stock was up 2% before the market opened, and the stock was down 2% for most of while the market was open. But they beat their they might roll off their sell off their Boots Alliance or whatever that's called. But I put money into Walgreens. Bought some Verizon on the dip, as you can see, kind of utilities, not just electrical utilities, but like telecom utilities going up. And then, yeah, so that's where the money went. But right now, it's just basically trying to increase those dividends, which has been my long-term goal, anyways. And then just going from there. But also, I wanted to go over the second portfolio. So I have another portfolio with a different brokerage. I'm not going to show it because there's just nothing going on there. It's with what was it? It's with Schwab, but I just picked a random brokerage. So basically, this is not so this would be more of an active type management type thing where I'm actively managing the profits in here. So like for example, selling Ford. This is more of a passive type account. This isn't an IRA because I don't want to wait till 59 and a half to get my money out. But this is more of a passive. So I bought SPHD, which is it's um, high dividend tracker, QYLD of course, and then Muni is a municipal bond tracker. So I've been pouring some money into here out of my actual checks. I have not been pulling any money out of here to put into here. So this is all just like basically if I have $100 left out or something like that, I just throw it in there and then put it in there. But so that's why the portfolio value, I have to add all these numbers now like that to get this number down here in the corner, 61,920. So that's where I'm at currently. And then when you add in this amount, I'm going to be easily over 62,300. That's if this number even stays the same. So let's see. We're watching the Fed, but like I said, the inflation report next week is going to cause a lot of drama in the market. It's going to be certainly something to see how the market reacts. It might be priced in. I strongly doubt a 7% inflation number is priced in. And it will give the Fed everything that they need to get very aggressive. And a very aggressive Fed is a Fed that makes mistakes. Because they start doing everything all at once and it never, ever, ever turns out good. I expect tech to get hammered. Once this tech trade right here, because you can kind of see what happened is like basically right here is a good example. In November you can see how it just boom, it dropped hard. You can kind of see like the inflation numbers came out, they came out at 6%. Tech just tanked. Then the Fed was like, oh, maybe there might be some hope from the Fed, maybe they might not go so quick. And then the Fed's like, yeah, we're going to hike rate. Tech tanked again. And then all of a sudden you get these people that are like, oh, no, everything's fine. They might go slow. And then the Fed's like, no, we're going to take inflation serious. And then tech tanks. When the Fed actually does come out and move, tech will tank hard again. Now, where it goes, I have no idea since I don't have a lot of exposure to it. But, it could drop pretty hard. But we'll have to see where that goes. I'm not going to add like Apple and that kind of stuff. I'm staying away from tech right now. Not even touching it anyways, but I'm not going to touch that until I see. I might, maybe if we get into another recession where like tech tanks or something like that, I might try to catch the lows on a lot of those stocks and get in at a good price and then ride it out from there. But the dividends, it's mostly dividend focused portfolio and the dividends are garbage. So, but as you can see, here's how the portfolio is doing right now. Utilities and basically consumer staples and financials are doing extremely well right now. But that's where we're at right now. So, like I said, leave me a comment if you have any questions. This is just where I'm currently allocated. I'm not adding anything else right now that I can think of. Maybe if Ford drops back down to 19 or 18 or something like that, I might add it. But And then I still haven't seen Pfizer. If you can look here, Pfizer. I still haven't seen Pfizer drop into that $52 range that I kind of wanted to pick it back up at because it's a really good stock. But I haven't seen it drop back into where it's like in that range where I want to see it drop. So as it stands right now, I'm not touching Pfizer either. But those would be the two stocks I would add back in if I see them. So yeah, leave a comment. Let me know if you have any questions. And I thank you and have a very nice day.